So here I am. So I wrote another article in the Hunt for Liquidity series. I'm planning to write 3 or 4, I guess 4. And I'm discussing various traditional technical analysis tools, and I'm arguing why those are better to be ignored in technical analysis. Essentially, this article focuses on moving averages and trend lines. And one could argue that, well, even major banks use moving averages and trend lines in their publicized analysis. But I would be very skeptical about any analysis or publication or trade recommendation coming from major players of the market, as who really would disclose their trading strategy or their intentions to the market. Those biggest banks, major banks, how many are of them? Maybe 5 or 10, or not only banks, but biggest participants, and maybe 20 of them you could count on a worldwide basis. And it's not a secret that a majority of forex market turnover is a speculative one, and you can imagine that those 10 or 20 big fishes, if they would trade only with each other, for them it would be a zero-sum game. You know, it's like you sit in a room with a couple of your friends and try to trade same instrument in between you. So it's so the main source of additional liquidity or opposing liquidity for their operations is a retail market, or not necessarily a retail market, maybe the wrong term, but let's say the rest of the crowd, as I like to call them. So they are interested very much into luring the crowd constantly in wrong direction. That's where they got that liquidity. They constantly push against the movement. If sentiment is bullish, then they try to short. If sentiment is bearish, general sentiment in the crowd, as for example, Euro currently has bearish sentiment. Everything thinks that, oh, US economy rebounding, Eurozone economy still struggles, and there is still unfinished business with Spain and Greece and so on. So fundamentally, Euro should be at much lower levels. Well, probably. I wouldn't argue that. But technically, it's showing some real bullish signs, and just a bit of a tryouts to hunt for some stop loss. Definitely, all the recent movements were strongly bullish, and every time you see a red daily candle or something like that, everything throws their analysis. Look, it's turning, top is forming, top is in place, and there are selling suggestions from various banks coming into financial media, and suddenly another bullish breakout, another bullish breakout, and another, and it still keeps moving. So who are those players? Who are those traders who sell, who buy into the resistant trend line? Who are those who sell into supporting moving average? You know, when you think about, there are someone who plays exactly the opposite scenario than what you expect from a traditional technical analysis standpoint. And those players who push, they succeed. They ignite those stop loss squeezes and push further away. So they have bigger pockets. And who are they? Major banks, naturally. So it's for me, it's clear as it can be. It's so obvious that this constant hunt for liquidity happens that I don't understand why there isn't a, a debate on a bit wider basis in Namibia and so on. So you always have to be aware that despite that instrument, let's say euro dollar is bullish, despite that there is some supporting canals, you always have to be aware that there will be a spike in the opposite direction if really there is a planned movement higher. Today's gold, for example, intraday gold charts 5-minute time frame. You can see those severe movements higher, and then something that top, and we see bullish breakouts. So who sold? You know that for gold, crowd sentiment is always a bullish, especially on a physical gold market, which is detached from the spot price significantly. I looked for some opportunities to buy physical gold recently at the bottom of the range, but I didn't got the price. It was several dozen dollars higher. So I guess what we see here on gold charts is always a bit far away from reality. Anyway, regarding trend lines and moving averages, if everyone would sell at moving average or trend line, then price would react and would reject that trend line or moving average. But often it doesn't happen. So you must understand that there are always part and not some casual of the participants, but the biggest fishes, biggest participants will always try to break those levels that we used to have especially as a newcomers. So my suggestion would be to maybe have some major moving averages or trend lines, the very most important ones. Try to ignore all the intraday drawings, and maybe have those points for reference. It's that there could be rejection happening, or actually there could be the point for breakout to happen. Sometimes trend line could help in terms of determining time. Let's say, as here is a quarterly chart in euro dollar. I have some price action level right here, yes, and I have a trend line. So I have a spot where next attack of the level could happen. Just for example, so maybe I shouldn't hurry too much with long positions right now, because this real test will come and it will give better levels to long. Maybe this is the example of a bit out of the box thinking regarding trend lines and moving averages. It's completely wrong to always assume that trend line or moving average will hold. It is much more profitable to assume that trend line or moving average will not hold. Maybe it will be broken for continuous movement, or maybe broken just for a spike, a fake spike. So maybe you could consider trade possible rejection level after overshoot, or just look for other levels above the trend line. For example, as we have on the quarterly charts, this trend line, if or when euro dollar will approach the trend line, I definitely wouldn't short here. Where I would short, just above those highs and below those, the most important highs. So this is the gap, the most sweet spot for short opportunities. So wait for overshoot, especially if overshoot happens with momentum within 1 or 2 sessions, and then on a possible exhaustion point, you fade the movement and close some of the partial positions right away after just few pips of the rejection. So maybe this could be the way to trade those traditional points of technical analysis. Here is one of the slides from the actual article, and this is how we chart the euro-dollar. And here I have 100 simple moving average, 100 period. It's a very good example which shows that how incorrectly one could assume that trend line got respected. The thing is that those lows that we have, they respected much more, much less obvious, but much more important levels. As here we have bull impulse point. You know, when we have a swing, often inside the swing there is a impulse point where the real beginning of a breakout movement will happen, and other part of the swing often is just a profit-taking point. So those profit-taking points are not defended. Defended are entry points. So when price approaches next time, this entry point, it got defended. Did we have some moving average nearby or not? It's irrelevant. Previously, price consolidated. So one of the biggest errors with moving averages and trend lines, with angular trend lines especially, that if price essentially doesn't move, if it consolidates and long enough, then some trend line or moving average will always approach price action. But it doesn't mean that on a breakout day it reacted actually to this approaching line. So it didn't even touch that moving average, but reacted to the most important technical point in our current range. After the breakout happened, we traced again, and again other next higher point was defended, and in this way higher highs and higher low sequence were maintained, and this especially this point was New York session lows, which was more a profit-taking point, but it was confirmed with the outcome later. Anyway, those distances you can spot from smaller time frames that the resistance started to appear somewhere 10 pips above the level. 10 pips is a very sneaky distance which often occurs around lowest level. So it either overshoots for some 10 pips or some key levels have started to really defend it. Sort of last barricade is often 10 pips away from intraday levels and 20 pips away from bigger swings, ranges. Later on, after range, previous bearish range, after it got broken, naturally, middle of that range were retested. So one could either, oh look, moving average was respected, but those middles are the most common behavior pattern, I would say. I do lots of things based on that assumption that middle will be retested. You know, and well, this is a static picture, I cannot zoom in, but the thing is that on breakout day, after overnight lows happened, before the real movement appeared, a bit of a stop loss happened. One of the perfect example that before the real movement is always hunt for liquidity. So it's better to concentrate on price action levels rather than do those overwhelming rollings. If you try to connect every high and low and start to play with various periods, moving averages, your charts become very busy and impossible to say what the next level will act or which will get open and which will hold. So during those years, my personal trading experience, actually quite I've dropped all those moving averages and trend lines quite long ago, and didn't even thought about possibility to maybe resume trading moving average, because I found that much more sufficient analysis methods and moving averages and trend lines are just not the right way to go. And also another flaw of trend lines is that it gives you very late entry. If you assume that downtrend is forming and you have two dots which connect a line, then third approach, despite the fact that third approach in the same supply area is always weak. So third approach is on its concept is weaker. You also entering at the way lower levels when you have maybe have a chance to enter at much higher levels on some other technical tools analysis. So another drawback. So that's it. I guess I highlighted the most important aspects of my article. The rest is in the article. So I hope you like it, and I hope I can get some feedback too. I would like to argue some position on the matter. So that's it for now. Thank you for attention, and bye-bye.